Hi, how are you doing? Hope you're doing well. And welcome back to this session in your corporate finance and investment banking program. It's good to see you again. I'm sure by now, based on our last session, you know what a basic income statement is. You also know what are the components of an income statement. This is what we built the last class. And we also built this basic income statement together in the last class. So you also know how to build a basic income statement. But again, I should insist on the word basic or a simple income statement because that is what this is. And as you rightly guessed, real life or a real company is rarely so simple and preliminary. What a company does is generally significantly more complicated than what we saw here. So obviously there are going to be special cases in these income statements. And in today's session, we are actually going to explore a couple of those special cases, which we will call accruals and how revenue recognition is done. How is revenue recognized? We'll get into that in the details. In this class, we'll also discuss some special cases of cost of goods sold. You remember this number right here, the number which you subtract from your revenue to get your gross margin. We're going to explore a couple of special cases of our cost of goods sold, the amount of money that a company uses to make its products. And then finally, we're going to wind up the session. Hopefully, we'll have time before the session is over, where we're going to explore how to analyze a company's income statement by using some financial ratios and how decisions are made. We're going to explore that as well. Now, before we actually dive into those three objectives of this session, I'm going to just walk you through a couple of terms that you've probably heard in the news and your colleagues or friends and all that. You've probably very oftentimes heard this term, the top line of a company, the bottom line of a company, right? What is the top line of a company? You probably know, but if you didn't know, this is the top line of the company. The revenue is the top line of a company because it's at the top of the income statement. It's called the top line of a company. Not very creative, but that's why it's called that. And you probably heard, what is your bottom line? Somebody probably says, this company's bottom line is so much. Or somebody asked you, what is your bottom line? That's the bottom line. And not just with finance, people also, just in normal conversations, people will ask you, all right, all this is fine. So what's the bottom line here? What they're actually meaning is, all this is fine. That's all's happened before. So because of all that, what happened? That's the bottom line. So a company's bottom line is nothing but its net income, and a company's top line is nothing but its total revenue. And whenever you hear salespeople and they're talking about we have to hit our targets, we have to hit our goals every month, we have targets every month, I have to sign up 15 customers. This is what targets contribute to. Targets contribute to a company's revenues. That's what salespeople are talking about. Now, another term you probably also come across is this whole term that a company is in the red, or a company is back in the black, or a company it's bleeding money, it's in the red. What people are generally referring to is this line right here, the net income. And this is like a old convention. I don't even know if people still follow it, but typically what happens is if a company is profitable, you would write that profit number in black color. But let's assume a company had a loss. Let's say in this case, let's say instead of an 87,000 rupee profit, it was actually an 87,000 rupee loss, you would actually make that red color. So you would say, my company is in the red. I'm trying to figure out how to get the company out of the red. And that's commonly used colloquially. So with that out of the way, one other thing I wanted to do today before we actually get into the goals is I wanted to show you what a real life income statement looks like. I wanted to walk you through that, and I also wanted to tell you where you can find these income statements. So sticking with our pizza theme, this is Domino's income statement. You see that? That is the income statement of Domino's. That's a real income statement. So you're already beginning to see how this slightly looks different. Not slightly, probably, quite significantly, looks different from what we built previously. Now, the first thing you should notice about this income statement is what we discussed previously. Remember that this October 2011, an income statement is always for a period of time. Similarly, if you go here, you will notice I was right. I was not fooling you. The income statement, you look at this. So this is typically how an income statement is presented. You rarely see an income statement just for 1 year. You'll always see an income statement for different years laid out next to each other, so it's easy to compare how the company's operations are progressing from year to year. So here you see this income statement. Here they have year ended March 31st, 2005. That means that is the yearly income statement. This column here is the yearly income statement of Domino's Pizza for 12 months ended March 31st. And before we get into financial year and all that, it's a little confusing because not all companies have their years starting in January and ending in December. Typically, companies, the calendar year might start in January and in December, but companies' financial years really depends. But most of them, their financial years will, roughly start in March of 1 year and end in the March of the next year. So when they say year ended March 31, 2005, that really means that is the statement of operations, profit or loss statement for this company from March 31st, 2004 to March 31st, 2005. All right, so we have that settled. Now the next column here is the income statement for the financial year 2006. Right here is the income statement of the financial year 2007, financial year 2008, financial year 2009. And what they've also done here is they've also given the financials of the company for a quarter, for 3 months. So typically a public company, a company that's listed in the stock exchange, they always report their results on a quarterly basis, on a 3-month basis. So 3 months ended June 30th, 2008. That basically means this column right here represents Domino's profit or loss statement for April, May, and June, for those 3 months. And similarly here, April, May, and June 2009. Now, do all companies present their income statements like this in this much detail? Not really. This is a special case, and I picked this case out because this was the income statement that Domino's presented when they were filing for their IPO some time back, their initial public offering. So name of the Domino's is a franchisee in India. The name of the company that owns the Domino's franchise in India is this company called Jubilant Foodworks Private Limited, or right now Public Limited. And when they were going public, they felt the need to show all their historical finances so that investors could look at this and make a informed decision on if they need to invest in this company or not. But typically companies will just report, that year and the previous year and maybe that quarter and the last 1 or 2 quarters. Okay, so let's take a deep dive into this income statement right here and see how it differs from the statement we looked at before. Sales from products manufactured by the company. So they've subdivided sales into 2 categories. The first is products manufactured by the company. That's simple. What does Domino's make? Pizzas, garlic bread, and I don't know, chicken wings and things like that. The second one, you see that we didn't use that in our simple income statement here. We just said number of pizzas sold. But you see the real pizza company, it says sales from products traded in by the company. What that specifically means here in Domino's is, you must have noticed when you go to a Domino's, pizza is not the only thing they sell there. They sell you Coke, they probably sell you fresh lime soda, they probably sell you some kind of molten lava chocolate cake. I think that's a recent cake introduction Domino's has. So they have all these products that they sell you, maybe some kind of a banana smoothie or things like that, which they don't make. They just buy it from somebody else and they sell it. That is this line right here, products traded in by the company. And then you always probably noticed that every time you pay your bill at a Domino's Pizza, let's say your bill is 500 rupees, then there is something called a VAT or a tax added, right? It says 12.5% or 5%, or based on what you ordered. There is a VAT tax. Now Domino's collects that VAT from you, but it doesn't go into their pocket, right? So this revenue here includes that VAT, but that VAT goes to the government. So it doesn't go into the company's operations. The company can't take that VAT you give them or the tax you give them. So they subtract that out right here, so that this sales number right here is a very good indication of what money the company has gotten as sales from its operations. Now, this statement right here is actually in millions. It's in rupees, it's in millions. So the right way to, it's not like, it's not as if, for example, in 2009 Domino's made 2,800 rupees in income. No, this is actually 280 crores. Okay, this is Domino's in 2009, in the year financial 2009, made 2,800 crores in, I'm sorry, 280 crores, not 2008, it's 280 crores in revenue. And you see how this revenue has been growing like fantastically. In 05 they made 73 crores in revenue, and can you believe that? I mean, 73 crores in revenue just selling pizzas. And then it went up to 97 crores, 138 crores, 211 crores, 280 crores, and so on and so forth. And I think this year Domino's revenue is about 450 crores or something like that. So it's a fantastic business if you want to go start, but you just have to be worried about the competition. So let's keep going down the statement right here. Raw materials. So you see how in our statement right here, we break down our raw materials consumed into cost of goods sold, and we have a gross margin line. For whatever reason, Domino's has chosen not to do that, right? They have clubbed their raw materials, the cost of the products that they've bought in, their staff cost, that their salary, their finance charges. That is typically another word for interest expenses. Domino's probably has a lot of loan or debt, and that's the interest they are paying in that debt. Depreciation or amortization, we'll come to that in a later session. So they have clubbed all the expenses into one bucket, and if you note, they have very smartly left out their marketing expenses. Now I don't know why, but if I were to guess, one of the things that I would guess is typically, for a company like Domino's, where pizza, anybody can make a fairly decent pizza, but a lot of Domino's strength is in marketing. So they don't want their competitors or somebody else to know how much they're spending on marketing expenses. So they will not break down their marketing expense. What they would rather do is, I don't know where, they're probably included it in this whole other expenses. It says manufacturing and other expenses, a good chunk of that is probably their marketing expense. So now you see how this whole thing differs from the simple income statement we build out here. And let's see if there's some other item here we should be looking at. There is inventories. So what that means is, apart from the ingredients that go into the cost of goods sold to make the pizza, they also have probably 1 week supply of cheese, 2 week supply of olive oil. They increase their inventories every time stock goes down somewhere else. So they have to pay money to buy new goods and stock their godown, or I don't know, maybe there's some kind of storeroom with all these ingredients. But that doesn't go into the cost of goods sold that year, because that is not used in that period to make the pizza. It's probably used in the next financial period. So this basically represents that most likely. And you see here they have something saying, oh, sorry about that. They also have something saying extraordinary items. Now, in this case, there are no extraordinary items, but typically you will see maybe in one specific year, some special transaction happened so that they got some more money. I don't know, maybe maybe they, I don't know, sold some part of their company, or some special income which is not here. So, and that line item generally represents the extraordinary income. The reason they separate that out is because when investors want to analyze a company, they want to know what are the recurring expenses and the recurring revenues. They generally don't want to know what are those one-time expenses, because they know that in a specific year, and one-time expense can either, it can skew the finances of a company, and it may not be an accurate representation. So they generally break that down as what is called an extraordinary expense. Okay, so I think this session, now we also have to discuss the accruals and the revenue recognition, which was initially set out as a goal for session, but I've already put you through, I think, almost 15 minutes of this. So what I'm going to do is actually save accruals, revenue recognition, and financial ratios for the next session. Okay, and so right now you should be, at the end of this session, you should be able to say what is actually the difference between the simple income statement we built and this real company's income statement. And before I forget, I should also show you where do you generally find this income statement of a company? There's a couple of different ways you can do it. The most straightforward way to do it is you go to a company's website. In case of Domino's, the company is called Jubilant Foodworks Public Limited, sorry. And every public limited company, they'll have this link somewhere on the top or at the bottom, most likely on the top of the website, where it says investors, or it might say investor relations. You click on that link, you go to the next page, and there you will always see the company's financial results, quarterly and annually. You'll also see their annual report. So for example, Jubilant's annual report, it looks something like this. So this is actually, this is not their annual report. This is the document they filed when they were about to go public. So this is their red herring prospectus, or the document you filed when you want to take a company public. So you typically, in the first 15-20 pages, you will find the company's income statement. So we'll scroll down here, so you really know how it is to look for an income statement, and you can't miss it. It'll be the first table of numbers. Is typical. There you go. That's their income. No, this is their balance sheet. There you go. This is their income statement right there. Okay, so that's how you can find a company's income statement, by looking at their annual report or their financial report. Another way to look at a very basic income statement that I like doing a lot because it's much faster and simpler is you go to Yahoo Finance, right? You just go to in.finance.yahoo.com, and then there's this search bar here. You type in Jubilant Foodworks Private Limited or whatever company you want, and then it will actually show you a summary first. It'll show you the stock price of the company and all of that. And somewhere here on the left, you'll find a link saying income statement. You click on that, and this is what you'll find. You'll find Jubilant's income statement for all these years. You can get quarterly information if you want to click it, and all of this. So yeah, there you go. So now you know how to read a real company's income statement, and you also know how to where to find these income statements for your analysis. In our next session, I'm going to keep up my promise, and we're going to finish up our goals of this session, which are looking at accrual accounting and revenue recognition, some special cases of cost of goods sold, and also some financial ratios. All right, thank you. See you soon.